morning, everyone. Welcome to our next panel. I'd like to first start off with a quick introduction. To my far left, we have Christopher Wood, Global Head Equity Strategy, Jefferies Hong Kong. Next will be Robert Gibbins, Founders and CIO, Autonomy Capital. Ms. Jean Chia, Global CIO, Bank of Singapore. And Amadeo, Head Systematic Equities, Jupiter Asset Management. And myself, Eric, from Medway Investments, a single-family office. So today we're going to touch on the topic of geopolitics of capital, tariffs, trade wars, and investment opportunity focus. We are in a world where geopolitics now shape investment returns as much as fundamentals and valuation matrix. Asia sits at the center of global trade, supply chain restructuring, and cross-border capital shifts. I'll begin by asking each speaker for a short framing statement. In one sentence, what is the most consequential geopolitical shift affecting investment decisions today? So maybe I'll start with Amadeo.
Yeah, sure. So what we've seen this year really is the reality that Asian equities, rather than being a single block, really offers a very rich and diverse set of opportunities. So while you had some big winners around tech, AI, chips, you've also seen some big losers in terms of companies more exposed to the export issues that have impacted tariffs. So really, it's been the uncertainty around tariffs and then how we as systematic investors can really harness quantifying opportunities and risks within that environment.
Great. And Jean from the private bank?
Yeah, hi everyone. So I represent the private wealth market, and at Bank of Singapore, we manage in excess of $140 billion in assets for private as well as family offices and families across the region, Singapore, Hong Kong, and the Middle East. So I would say that the geo-economic shifts that we are seeing around the world do definitely impact our capital allocation decisions, but we have the advantage of being completely agnostic as to where we invest and how we invest. We're not tied necessarily just to the traditional asset owner framework or the long-only framework of indices, et cetera. We really go where the capital is, and we risk manage the assets the way that we think is important, especially in the new environment where uncertainty is a certainty.
Yeah, indeed. And Robert.
Hi, everybody. I'm here to talk about energy. And I think that energy, for me, is, at the moment, everything. And I'll just give a few, a few framing comments. Chinese, in the last 3.5 years, put in 1 terawatt of solar. And the battery systems to back it are now ramping up at about 70% per annum. By 2030, we think that'll be around 4 terawatts. By 2040, we think that'll be around 25 terawatts. That compares to the existing US system of 1.2 terawatts, and it took them 100 years to do it. There's a huge difference between having a stock-based system and a flow-based system. And it's critical to understand that. And the reason it's important to understand it is if you own energy, if you own electricity, if you own the dominant energy system of the time, then you own the electric stack and you own the future. And I think that's critical to understand. And that's what I'm going to be talking about today.
And over to Chris.
Yeah, so we started the year with a big focus on tariffs. Clearly, the markets have got relaxed about tariffs because they've been concentrating on AI. But in my view, the longer the tariffs are in place, the more negative their implications. In terms of the geopolitics, we have a fundamental difference of approach. We had the US-China meeting the other day in Korea. Donald Trump's approach remains primarily bilateral. And the Chinese, after that meeting, in the statements coming out of the official media, have emphasized that they remain committed to globalization integration. They have emphasized the ongoing huge explosion in trade between emerging markets outside G7. And clearly the energy change in China, Robert just alluded to, is another big differentiating factor. So on the AI, where you've got the US and China competing, in my view, while the Chinese approach makes a lot more sense, you need two things for AI. You need compute and energy. The way I've been looking at it recently is that the Chinese are way more ahead in energy than the US is ahead of the China in compute. And the US effort to try and try and limit exports of semiconductors to China in recent years will end up being a major own goal because it's incentivized China to accelerate the progress in compute.
Wonderful. Now, if I can then go into deep dive. So we know tariffs and trade disputes dominate headlines these days, right? Asia is central to supply chains, manufacturing hubs, and regional trade corridors. So let's discuss the impact of strategic decoupling. In a sense, Amadeo, from a systematic equities perspective, how are Asian markets pricing trade tensions?
Yeah, so from a systematic equities perspective, what we've seen is very rapid shifts in sentiment. If we now look over the last 12 months, we can almost think that we've gone through a full mini cycle. From Donald Trump winning the election and the very aggressive, obviously, policy set of expectations, dominating expensive growth, to then the cooling off of that growth rally early this year, and then back to growth post-April. So sentiment has really been a key driver of markets, and for us, the success has been in blending a very disciplined, fundamental approach to understanding thousands of companies worldwide, and really looking at how those big macro policy decisions are really impacting specific companies at the fundamental level. And then also blending the reality of a sentiment-driven market. Being a fundamental investor is not enough to be a successful stock picker and in these types of environments that are very policy dominated.
So that means you actually data crunch a lot of data then?
Yeah, that's one of the benefits of being systematic, quantitative manager. At Jupiter, we benefit from a very strong infrastructure, cloud infrastructure, and data science framework. So we are analyzing over 40 million data points to fully understand the opportunities of a very large investable universe, which is global. Asia has provided a very rich source of long-short opportunities, especially in recent years. And all this uncertainty really translates into opportunities for long-short specific stocks, trying to pick up the winners and losers of those kinds of big geopolitical shifts.
Wonderful, nice things to hear about Asia. Now, going to Jean, how does this inform your macro allocation across Asia then?
Yeah, so being an investor, especially in this generation, is a very humbling profession because you can plan for the best laid plans in terms of your expected return, but you really have to be prepared to be completely wrong. And I think these couple of years since COVID, I think we have been taught some tough lessons in terms of our expectations of what constitutes a safe haven, what constitutes a safe market, and what constitutes risk. So I think today, with our lenses on, I think we need to look at it from a multipolar world perspective, is scratch away all the assumptions we've made about developed and emerging markets, because the developed markets is also full of risks, such as, for example, duration can be a big risk in developed markets, fixed income. And at the same time, emerging markets can afford us a lot of growth, which we may have neglected, in the heyday of the US exceptionalism. So I think today, from the macro context, I would look at it more as the level of preparedness at the company, sovereign level, at the corporate level, and at your own fund level. How prepared are we for the disruption that we're seeing from the geoeconomic standpoint? And just to be specific, the most, I think, significant risk that we've seen this year is the US dollar. I mean, if we'd sat and did nothing, we would have been down 8% based on DXY. So the question is, how many of us prepared for this scenario, especially if US dollar was not our home currency, which is in the case of many Asian families and businesses like ourselves, we have our core allocation into our primary currency, which is our home currency business or portfolio, and we have a US dollar portfolio, which we presume to be a representative of our external or investment portfolio. Now, I advocate for thinking about the third currency. The third currency in my mind is whatever that is for you: Swiss franc, Japanese yen, Sing dollar. I would advocate as a very strong candidate, as well as gold. Then that dynamic can change and will continue to change, because currency volatility will be something that we have to get right in the years ahead, primarily because the assumption that we've made on the US dollar status at the margin, even if at the margin, will impact our overall return over the next 5 to 10 years.
Right. And you mentioned about the home currency Sing dollar is measured against a basket of Asian currencies as well, right?
Yeah, so if I could speak for the Sing dollar, not because I'm Singaporean, but because as an investor in the region, you are looking for currency stability. And the way the Monetary Authority of Singapore manages the currency is principally for stability against a basket of currencies of our trade partners and against in a band. So therefore, by nature of the currency, it is designed to be stable and therefore very suitable for investors looking for that stability. On the other hand, of course, the criticism would be that the number of investment opportunities in Sing dollar may be limited, but that's rapidly changing with what the government is also doing to expand the capital markets and improve the liquidity of the market.
Great, thank you. And Robert, earlier you mentioned about the dynamics of energy. So with that, where do you see the investment opportunities arising amid these shifts?
Well, I want to go back to your first question, and I just want to ask the audience, if I can, just a show of hands, how many people here think that the US trade war is going as they expected vis-a-vis China? How many people think it's not going so well? Yeah. The US, it needs terawatts of power now. Not in 15 years, not in 10 years. It needs it now. If you take a look at nuclear, right, which is a cornerstone of the American energy dominance program, my bet is in the next 5 years, 2 gigawatts, maybe 5 gigawatts, in a system where the Chinese will be adding 3,000 gigawatts of additional solar alone, not including other energy systems. So there is no energy dominance plan in the States. And increasingly, I think the tech community there is peeling away. I think the one person who got it from the start was Elon Musk. And they realize that they need power now. So to me, if we think about tariffs, if we think about this trade negotiation, if we think about how this is going to shape up, unfortunately for them, the people who have complete dominance in this new system are the Chinese. And that's really the framework that we should think about these meetings going forward. I completely agree with Chris, whom I've known for a long time. I mean, incidentally, his portfolio is up 40 times since beginning of 2000s, which is pretty impressive. Look, when we think about the electric stack, when we think about energy systems, let's think at one end of the spectrum, which is intelligence. And in some senses now, through LLMs, energy is intelligence, right? If you want to win in intelligence, you need a team. It's a team sport. You can have Messi out there, but if there's nobody else on the team, right, it's going to lose versus, for example, the Czech national team with no-name players, right? Because it's going to be a complete package. And here, if you don't have a whole suite of things, including proprietary data, including LLMs, including chips, and including at-scale power, then you shouldn't be in the game. So this is a tough spot for the Americans. I think most of us know Scott Bessent. I think he went in this with quite a conventional perspective that the current account deficit nation wins in a trade war. But this is a phase change. This doesn't happen much. It's a technological disruption based on price and capacity at the core of our energy systems. And if you don't understand that, you won't understand the scaling laws, and you won't understand the economy to which we're going. And it's a transformation, not a one-to-one substitution, has nothing to do with green.
Thank you. It's very insightful. Now, Chris, with your vast experience and what Robert mentioned about China, which Asian economies are most exposed or insulated from these trade disruptions, or are there any?
From the trade disruptions?
Yeah.
Yeah, my view, long-term view on Asia, Robert's very kind to mention obviously my portfolio in Green and Fear is a paper portfolio. It's not actually being invested, but I've been running my Green and Fear Asia ex-Japan portfolio since 2002. I would say most of the biggest gains from my portfolio since 2002 have been in Indian equities. So my view for the last 20 years has been India is the best structural equity story. However, I think with what's going on in China, China's becoming extremely interesting. So I view China and India as very complementary in an equity portfolio on a long-term view, because they're both very interesting, but they're almost different from each other in almost every aspect. And that makes them very complementary together in an equity portfolio. India is the big domestic demand story. India is primarily an internal domestic demand story. India right now is also the non-AI story. So if all the AI stocks collapse tomorrow, India would outperform. But China, in my view, is in the best position to win on AI. And obviously AI is coming, but it may not be, but just because AI is coming doesn't mean that these large language models you see today being developed in the US at vast expense are going to reach AGI. I don't buy that. But the big picture, yeah, China and India are two places people should be investing in. And as I say, they're complementary in the portfolio because they're different in every way.
Great. Now, if I may shift again to this theme about sectorial winners and losers, right? So trade wars create winners and losers at the sector level. So let's explore which sectors in Asia benefit from tariffs and which are under pressure. So maybe I'd like Chris, for you. Which sectors in Asia are likely to outperform under current geopolitical conditions?
Well, how do we... Yeah, well, on the tariffs, I think this is hard to how it's playing out, because right now, Donald Trump said when the tariffs first came that the exporters would eat the tariffs. So you take the Pacific example of the Japanese car makers, actually they did eat the tariffs initially. They cut the prices. But my view is simple. The longer the situation prevails, the more the annualized, I think the tariffs are running at an annualized $350 billion in America. The longer the situation prevails, the more the exporters and the companies will have to pass on the end cost to the consumer. But it's very hard to make fixed predictions because Donald Trump's a moving target. He's doing these bilateral deals. He's currently got a 50% tariff in India. What I heard yesterday is the Indians are hoping this is going to be cut to 15% by the end of November. And then we've got the US Donald Trump threat to massively impose charges on so-called transshipments. That's where Chinese goods are exported to the US via third-party countries. Most Vietnam, Malaysia, Mexico, India, they've all been... So the US has threatened actions. They're potentially talking about a 40% levy on this, but actually nothing's been agreed. So the whole thing is completely uncertain, unpredictable, and it's been more unpredictable because of the bilateral focus. So the US has gone rogue in the global trading system. And the key point is China is going to win the moral high ground because they just keep emphasizing the same message that we believe in globalization etc. If you read the official Chinese media reports of the meeting in Korea, you'll get the point. So Donald Trump left before the multilateral meeting, and the Chinese president stayed. That's the key point.
Great. And to Robert, you mentioned, you highlighted a lot of interesting insights about the energy market and what the opportunities arise from there. So are there overlooked sectors or niche opportunities within the space that you're operating in?
Yeah, I think that, I really think that the key thing here is when people understand that it's a technological disruption based on price and capacity, it's a transformation in their perception. And one of the issues that we have is the narrative, right? Narrative, I've realized we're not so different from our 14th century religious, ancestors. On the left, they see this as a decarbonization agenda. And if you see it as a decarbonization agenda, then what you see is a one-for-one transition. Shut down coal, do solar, what have you. And what that ends up being is a deindustrialization agenda. And on the right, they're sick of the deindustrialization agenda, and they're annoyed by it, but they don't also understand that the phase change is here. And so what they want to do is they want to go back to old technologies and make them great again. But there's no going back to the past technology to make something great again. And I think so often we don't ask ourselves, what makes us something great? What made Great Britain great in the 1800s? Dominance of steam technology. What made America, Japan, and Germany great in the 20th century? Dominance of the internal combustion engine backed by gas and oil. We are heading to a computational economy. I gave you some figures in the first statement, which are, I think, shocking to some. It speaks to the scale of which we're going to transform ourselves into a computational economy. Everything follows from that. If you own the electric stack, it's national security through drones, defense. It's transportation through electric vehicles. It's intelligence. It's everything in between. And it's really critical that you think in systems first. Don't think about the trade. Think about the systems transformation and the value in the new system. That's what's critical here.
Very nicely put. Now, if I can then go to Jean in extension to what Robert mentioned. So how do you navigate portfolio allocations amidst these intricacies that's coming out from the non-conventional lens?
Yeah, if I could just go back to the point you're making about tariffs. Tariffs are but a tool. The heart of this is actually reindustrialization and the fact that we will have to look at which countries will be most successful in industrial policy going forward. And to the extent that China is a practiced country in terms of industrial policy, in fact, sometimes too successful, which is why we often see oversupply in certain areas, and that's why the Chinese government has also recently stepped in with the Fan Neijuan or anti-involution policies to also curb excesses when industrial policy goes too well. And actually at the heart of that industrial policy success is not just tariffs, but the materials and the export controls. Right. And we all know now that the choke point is really rare earth, right? And it's not, which is why it's not a moral high ground, it's pure economics and pure supply chain dynamics that puts China now at a moral high ground with regards to the supply chain. And so I think that's where we will have to relook the sources of innovation, to Robert's point, on energy and on where innovation will come from. For me, there's also the other angle of immigration and the fact that there's a brain, or rather a scientific immigration shift going on where many top scientists and innovators are also returning to where they came from, which would be India, China, Korea, Japan, etc. So we will, as capital allocators, need to look at where are the sources of innovation going forward and not backwards, and where we will see new technologies and new breakthroughs in science may not come from the West or the US anymore. Perhaps there will be 2 centers, 3 centers, or even more where we do look at that. So from our perspective, from an asset allocation perspective, we have been trying to look beyond the traditional sense of asset classes, of what is in credit versus equities, private versus public, but look at everything more from a continuum of opportunity sets. And they can reside in any of these traditional capital stack, but looking more at a total return standpoint and being agnostic to geographical allocations is very important, because a company that is headquartered in Asia but listed in the US, a company that's listed in Asia but does most of its business in Europe, we have to contend with that sort of an economy going forward, because companies will have to adapt, and the adaptation will mean that the lines will blur from capital allocation perspective. So from our perspective, we have optimized our portfolios to go beyond the traditional market cap weights to what we call robust optimization, which is a lens that looks for the best opportunities, risk managed against a multiplicity of outcomes.
Great, thank you. And Amadeo, on the same question, how do you then model sector rotation in response to trade disruptions?
Yeah, in terms of all these topics that have been discussed, from a Jupiter perspective, the big investment opportunity is about harnessing the dispersion of long-short opportunities in an equity market-neutral framework. And indeed, sectors and industries are one of the key drivers of navigating these challenges. Within the AI topic, where we've seen a lot of success, and this is something that we continue to see going forward, it's not so much kind of betting on the energy challenges and the big AI spenders, but rather those companies that have been successful at harnessing AI technology to increase efficiencies. For example, sitting here in Singapore, some of the local banks have done a great job of really, very efficiently improving their processes and extracting benefits to the bottom line. So this is where we see a lot of those kind of AI sector and industry opportunities, very at the stock level, those companies that will be harnessing that power. And then clearly on the losing side, some of those stocks that have been more exposed historically to just simply exporting to the US and Europe, given the reshoring initiatives within the US, this is likely to continue to be a headwind.
Okay, so to the audience, so we've heard from Chris about China-India opportunities. We've heard from Robert about the energy sector opportunities. Jean from the wealth perspective, and then Amadeo from the systematic perspective. So in closing, I'd like each panelist to offer a forward-looking insight for investors in Asia, right? Opportunities to overweight, underweight, or avoid. So perhaps I'm going to start with Amadeo. What would be your top actionable insight for equities?
For us, it would be equity market neutral, avoiding directionality and diversifying the big risks in the macro space and focusing on a diversified portfolio.
Okay, Jean, what's your top portfolio allocation takeaway?
So to the portfolio allocators out there, I think it's time to review, recalibrate your risks as well as expected return, and rebalance in favor, hopefully, of the drivers of growth.
All right. And Robert, your top investment opportunity in the alternative space?
For me, it's understanding the context of the systems change and working down from there. So this change is systemic. It's going to impact every aspect of your portfolio. So everything falls out of it. A few things. Chinese AI and intelligence is obviously a winner. The electric stack is critically important to dominate, and there are certain companies that do dominate their areas in that stack. And I think that looking at the trade war from the perspective of US needs, not wants, but needs, and they need terawatts now, is going to help you a lot in terms of thinking through how things are going to end up.
Great, thank you. And Chris, if you can end off, your key message on risk adjustment.
Well, as we're here in Singapore, and I'm assuming there's the wealth managers, I would advise everybody to move their currency of reference to the Singapore dollar, which is the nearest thing to the Swiss franc in Asia. And my long-term target on the Singapore dollar is parity with US dollar. And long-term target on the renminbi is 5. And at some point in the next few years, they'll revalue the Hong Kong dollar against the US dollar.
100%.
Because the interest rates will be too high in Hong Kong relative to the rates in the mainland.
Great, thank you.
Thank you.
With that, due to time, we have to end the panel. Thank you, everyone, for listening in. Thank you.